So this is CFA Level 1, Quantitative Methods, and we are in the first session, which is Rates and Return. Altogether, there are 11 modules, which the Institute wants you to understand and have an appreciation for. Now, each of this session has been structured in such a manner that we give you the learning outcome that the Institute wants. And this is something we consistently harp on you, because having the learning outcome at the back of your mind is critical, so that you always have the understanding as to what the expectation of the Institute has when it has designed this entire curriculum. So let's begin with the learning outcome, which is there. Prescribes 5 specific learning outcomes that you need to have an appreciation. And the first one is the ability to interpret interest rates. So these interest rates, what do they mean, how they are structured, and what exactly do they indicate, how we calculate it, and what are the various forms in which it is utilized. That is something which you need to have an understanding. You should be able to calculate and interpret different approaches to return investments, and you should be able to compare money-weighted and time-weighted rates of return and evaluate performance of portfolio. You should be able to calculate and interpret, analyze return measures, and continuously compounded returns and describe uses. You should be able to calculate and interpret major return measures and describe their appropriate uses. So if you look at the learning outcome that the Institute has provided with regard to interest rates, having an understanding of its definitions, the way it is calculated, and the way interest rates are used to measure returns on specific portfolios. This is the broader structure which the Institute has provided. Now, let us go into the first session, in which we'll be discussing more about interest rates and what defines an interest rate and how it is constituted. So this is session 1. And in this session, we're going to spend time and understand how interest rates are actually constituted. So you'll be focusing on these 2 specific segments, that how do we define interest rates and how do you determine interest rates. Firstly, what do we mean by interest rates? So if you look at the definition of interest rate, the interest rate is defined as a rate of return that reflects the relationship between differently dated timed cash flows. So there is a cash flow over a certain period of time, and the relationship between the cash flow as of today versus the cash flow as on a future date or a time is what we mean when we speak about interest rates. Let us understand this with an illustration. So if USD 9,500 today and USD 10,000 in 1 year are equivalent in value, so we are speaking about an interest rate on an amount of rupees 9,500, which makes this amount equal to $10,000 at some point of time in future. So if you look at this illustration, we are speaking about 4 things. 1, there is a number we are discussing today, which is 9,500 USD. There is a number we are talking about sometimes in the future, which is 10,000 USD. And we are saying both these figures are equal. If we are saying both these figures are equal over a timeline, which is today versus a year down the line, then the difference between these 2 numbers in absolute terms are what we refer to as rate of interest. So if you're supposed to calculate, for this example, the interest rate, it would be equal to 10,000 US dollars less 9,500 US dollars, which gives you 500 US dollars. So 500 US dollars upon 9,500 US dollars, that gives you a rate of interest of 5.26%. This is something which most of you would have studied in the past. There is nothing new in this, And we all know that when we speak of rate of interest, it's a return which we talk about on some specific base value. And the base value in this case is 9,500 US dollars, on which we are getting an interest of 500 over a period of 1 year. So if you look at the definition we spoke about, we said it's a rate of return that reflects the relationship between differently dated timed cash flows. So let us now get into what exactly constitutes the interest rates, and what are the ways in which we can understand it. And till today, and most of you, I'm assuming most of you are fresh out of the college, or you might have spent like a year or so in the industry working as an analyst or an associate with some level of experience in the industry. But rate of interest for us always has been some form of return we call on an investment. Now, let us bring a further explanation to this whole thing. There are three different views in which you can actually look at interest rates. Number one, it is a required rate of return. And when you speak about rate of interest, the first understanding that we have is it's actually a rate of return on some specific amount of investment. In the previous illustration we spoke about, the 500 US dollars over a base of 9,500 USD was what was a return which equated to 5.26%. The second way in which we can look at is a discount rate. In the previous illustration, we had a number, 10,000 US dollars, 1 year from now. So the number of 10,000 US dollars a year from now was actually equal to the figure of 9,500 US dollar today. And that is how you got an interest rate of 5.26%. So if you use that number 5.26% as a discount rate on the future value of 10,000 US dollars, you will arrive to a number of 9,500 today. So when you speak of the discount rate, you're speaking about a number which is used to discount a future value. So if there is a future value, the rate of interest in that case is called as a discount rate, which is used to discount a future value to bring it to today's value. The third is the opportunity cost. Now, in most of the cases, when we talk about opportunity cost, so there is a compulsion for someone to actually have a consumption today. Despite that consumption, the person is willing to let go of that consumption and push it to sometimes into the future. And for this endeavor to push the consumption sometimes into the future, because they have foregone the consumption today, they have to be compensated. And that is what we refer in this situation as an opportunity cost. So whether you speak of the required rate of return, or you're speaking of the discount rate, or you're speaking about opportunity cost, it is the context in which it is being discussed. That is what is important. So in the previous example, the party who supplied USD 9,500, there was somebody who was willing to use that 9,500 today. And so there was a supplier. So the supplier who had in possession 9,500 USD, instead of consuming it today, he or she decided to give it to someone else, and that someone else consumed it, invested it, and at the end of 12 months period, had to return 10,000 USD. So that absolute amount of 500 USD is the opportunity cost, which is equal to the rate of interest, which is in return, which is equal to the discount rate of 5.26% on a future value of 10,000, which brings it down to 9,500 USD. Now, up till now, it seems pretty straightforward. So we have understood that rate of interest is in certain way, in certain situations, are also referred to as discount rates, and in certain situations can also be referred to as the opportunity cost. But what determines interest rates? And most of you in your undergraduate program or even at your in your schools, you would have studied what exactly is an interest rate. But what determines interest rate? This is something which a few of you might have an understanding. You might have studied this in the past, but this is something which is now building upon the base understanding that you had in the past. So what determines the interest rates? Economics everywhere, in any part of something which needs to be determined economically, are actually set by the forces of supply and demand. In this case, there is somebody who has the capital with himself or herself, and in the previous illustration we had that was 9,500 USD. So the person who has in his or her possession that 9,500 USD is a supplier of capital, so as to say. And somebody who is willing to use that or borrow that and return after 12 months, 10,000 USD is the consumer. So there is a supplier who is supplying, and there is somebody who is creating a demand. So if there is a higher supply and there is a lower demand, the interest rates would be lower, and vice versa. So this is a very straightforward and very simple understanding of what interest rate can be. But there is something deeper to this. And what is deeper to this is to give a structure, because in finance, and most of you are going to be in the space of finance in the foreseeable future, doing pretty much a lot of things when it comes to finance, you have to put a structure to it, because you cannot be going into the market to figure out who are the suppliers and who are the consumers, who needs capital, who can supply capital. But let's put a structure, because once you have the structure, you can figure it out what is coming from where, because this interest rates across the world can vary. In the USA, the interest rates could be different compared to what it will be in Europe. And Europe, again, different countries might have different interest rates. And so might be the case in Asia. So interest rates, we represent them by R, which is the standard representation that we use for interest rates. Interest rates, we are bringing a new term here, is equal to the real risk-free interest rate. So this is something which is going to remain the base. And this base is topped with inflation premium, default risk premium, liquidity premium, and maturity premium. So please remember this, put this structure at the back of your head, in your mind, register it, that interest rate, how is it determined? It is determined by supply and demand. So there are suppliers and there are consumers. So those who are the borrowers, those who are the suppliers, the equation of demand and supply is what decides a specific interest rate. The framework of interest rate is equal to a real risk-free interest rate. It is equal to inflation premium, default risk premium, liquidity premium, and maturity premium. Now, we will look into all of this, a specific set of items, one by one. So let's get into understanding. In the previous slide, we understood this overall structure that the interest rate has. So there is a real risk-free interest rate, and on this real risk-free interest rate, we add inflation premium, default risk premium, liquidity premium, and maturity premium. Now, let us understand this one by one. So, the real risk-free interest rates, and this again, while this is the base for computing interest rate, not necessarily this is going to remain a constant number. It again varies depending on the context, where we are discussing, and most importantly, it varies from geography to geography. So if you're discussing in the US, you will have a different risk-free interest rate. If you're discussing in Asia, India might have a different risk-free interest rate, and we will get into it as to what exactly constitutes a risk-free interest rates. But importantly, the real risk-free interest rate is a single period interest rate for a completely risk-free security with no inflation. So when we speak of a real risk-free interest rates, we are actually referring to a risk-free security with no inflation. So there is no inflation on this, and it reflects preference of individuals for current versus future real consumption. So there is an assumption, and it is not partially, but to a great extent, it is a fact that there is a drive for consumption in present than in future. So the real risk-free interest rate, the structure to be registered in your mind is it's a risk-free security with no inflation. So there is a rate of return which is there on a risk-free security. So what is a risk-free security and what is inflation? We will put a structure to that very quickly and very shortly. But for the time being, just keep in mind that the real risk-free interest rate is an interest rate on a completely risk-free security with no inflation. So the second is, what exactly is inflation premium? Now, inflation premium, it compensates investors for expected inflation and reflects the average inflation rate expected over instrument period. So inflation is if there are two time periods, say over a period of 1 year. Now in the first month, you have a consumption basket. The cost of it is X for a specific consumption basket. The cost of that consumption basket, the same consumption basket a year down the line, is expected to change. It might go up, it might go down. But typically, inflation is something where you, as a concept, the assumption is over a period of 1 year, the cost is going to improve. Now, if the cost is going to improve, somebody who is parting away with a decision to consume today will be consuming sometimes in the future. If there is no inflation premium, the person will be worse off by setting away, by pushing away the consumption to sometimes into the future. So you have to compensate to ensure that the ability of the person who is delaying consumption remains the same with regards to the basket of consumption which he would have otherwise been able to consume at the initial point of time versus the future point of time to which the person has pushed the consumption away. The next concept is default risk premium. So default risk premium is, and this is quite interesting to understand, the default risk premium assumes that the borrower there is a possibility that the borrower will fail to make a promised payment. Now, when somebody makes a borrowing, there are certain returns which go to the lender. And those are periodic returns or a terminal return. There are multiple stage returns. We will be discussing all of that in the subsequent slides. But for the time being, let us understand that when you have a default risk premium, the assumption is there is a possibility that the borrower might default. Now, the borrower might default doesn't mean that the borrower will completely not pay. The understanding is the borrower may not pay at the contracted time and in the contracted amount. So there might be a delay. Instead of returning the money at the end of 1 year, the person returns the money 13 months down the line. Or there is a shortfall in the amount. So the time and the contracted amount. So there is no absolute default, so as to say, but there might be a possibility of time being extended or the amount. There might be some short amount because of certain exigencies that the borrower might have, or the borrower is unable to meet his or her own set of hurdle rates. So if the person is not able to achieve certain returns on the investment for which it was borrowed in the first place, then that situation there might be some default risk, and that is what you top with certain number, the real risk-free rate. So you are adding the default risk premium along with inflation premium to the real risk-free interest rates. The next is the liquidity premium. Now, when you speak of liquidity premium, it's the risk of loss relative to an investment's fair value. The investment needs to be converted to cash quickly. Now, despite the supplier, who is the lender in this case, of capital, who has parted away with his capital and pushing away the consumption to sometimes into the future, realizes his or her own need of liquidity during the period in which it was lent out. Now, if there is an immediate requirement and the person fails to liquidate or monetize his or her investment, that is a number we need to add to the real risk-free rate to come to the interest rate. So there are certain asset classes where those assets are fairly liquid, like you speak about investment in listed equities on the stock market. The person can actually go, there might be a delay if it's a weekend, the person might just wait over the weekend, so there will be a delay of 2 days. But on a working day where the stock exchange, the stock market is functional, and the stock is fairly liquid, the person can go and can liquidate his or her investment. So there the liquidity premium will be low. And vice versa. If the stock is not fairly liquid, there are not enough buyers or investors in those, then the liquidity premium for such investments should be high. And finally, we speak about maturity premium. And maturity premium refers to the increased sensitivity of the market value of debt to a change in market interest rate as maturity is extended. So what happens is maturity premium is a situation where the economic conditions during the period of lending changes. So if there is, say for instance, during the period the interest rates are expected to strengthen, or during the period the interest rates are expected to weaken. Both the situations could happen. So maturity premium is used to address these kind of situations. So in a market where there is a continuous demand for capital, where there are massive amount of investments which are happening, there could be a requirement for maturity premium to be brought in to calculate the interest rates. So let us now summarize what we have learned in this session up till now. We have learned the definition of interest rates. So interest rates we represent it by R, and it is actually a rate of return, or it could be a discount rate, or it could be an opportunity cost, depending on in what context it is being discussed. And we have also looked into what are the components that constitute interest rates, and there are 5 specific constituents which determine an interest rate. The first is the real risk-free interest rates, and once you have the real risk-free interest rate, you top it up with inflation premium, default risk premium, liquidity premium, and maturity premium. Now, I want to highlight at this stage that these 4 different kinds of premiums that we add to the real risk-free interest rates, this is not an exhaustive structure. There could be situations where you might need to top this up with something else. And there are situations which we'll be discussing in subsequent sessions, but there are situations where you might need to have different premiums because the expectation as a lender or investor, you expect something more, and there are valid reasons for that. And so these were at this stage when you're learning, just keep your mind open that this is not a fixed structure. There could be situations where there could be other premiums also, which will be part of the lectures that you'll be undergoing in the subsequent sessions. So we are ending it here, and if you have any query, please comment below. Please drop in a line and I'll be happy to come back to you. You could also reach out to www.krawl.org and drop in your comment or questions. You could follow us on Discord and on YouTube, and we will be happy to address your queries if you have. Thank you.